A senior project manager I know left a Big Five bank last year. Her base salary was $140,000. Total compensation, including bonus, pension match, and benefits, was closer to $180,000. She signed her first independent contract at a day rate of $900. She did the math on her phone in the parking lot and multiplied 900 by 220 business days a year, got just under $200,000, and concluded she had given herself a raise. Well, she was wrong. By the end of her first calendar year, she netted less than she would have made staying employed. Not because the rate was low, but because the math was wrong. I'm Kes Edafiogo, and this is Career Leverage, your executive edge. And today we're going to do the math properly, the way I wish someone had done it for me, so you do not sign your first contract in the parking lot, comforting set of bad assumptions. Welcome back to Career Leverage, your executive edge. In episode 1, I made the case for and against going independent. And I told you that the next 2 episodes were going to be the financial and legal foundations. Today is the financial one. I want to walk you through step by step what actually happens to $1 of revenue when you bill it as an independent consultant in Canada. Because the gap between the gross revenue and what lands in your personal bank account is much wider than people who have only ever worked as employees expect. And if you set your rate based on your old salary divided by some number of days, you will undercharge yourself by about 20 to 40%. I have done it. Most independents I know have done it. So let's make sure you don't do it. But before we go further, I have a disclaimer. I'm not your accountant. I'm not your financial advisor. The numbers I'm about to walk you through are illustrative numbers. Your specific tax situation will depend on your province, your corporate structure, and other income sources, as well as a dozen other variables. So please treat this as a framework, not a filing. And of course, get a real accountant before you sign your first contract. So with that being said, let's get into it. So I want you to imagine a stack. And at the top of that stack is your gross billable revenue, the numbers on the invoice. And at the bottom of that stack is what you actually take home and can spend. Somewhere between these 2 numbers, there are about 7 layers, and every one of them takes a bite. Layer 1 is downtime. You do not bill 52 weeks a year. Realistically, a healthy independent contractor in financial services or the government in Canada bills somewhere between 180 to 210 days a year. The rest is between contract time, statutory holidays, vacations, sick days, business development, training, and of course the occasional week where a contract simply doesn't materialize on time. So when you do the math, you do not multiply your day rate by 250, you multiply it by 200 and the optimistic end, and 180 and at the realistic end. Layer 2 is, of course, HST. If you're billing more than $30,000 in any rolling 4-quarter period, which is essentially every senior consultant on day 1, you are required to register for and charge HST. You collect HST from your clients, but you remit it to the CRA, the Canada Revenue Agency. So it basically passes through you. The trap is that you may forget it's not yours, you may use it for cash flow, and then you owe it at quarter end and you simply do not have it. Treat HST as a liability the moment it lands in your account. Layer 3 is corporate tax, if you incorporate. We will talk about whether to incorporate in episode 3, but assuming you do, and assuming you qualify for the small business deductions in Ontario, your corporate income tax is around 12.5% on the first $500,000 of active business income. If you are caught by the personal services business rule, which we'll talk about in episode 3, that rate jumps to about 33% federal plus provincial, and you cannot deduct more expenses. That PSB risk is real, and it changes the math significantly. Layer 4 is personal tax on the money you pull out of the corporation as salary or dividends. Whatever sits inside the corporation is taxed at the corporate rate. Whatever you pay yourself personally is taxed again at your marginal personal rate. And Canada has integration rules, so you are not taxed twice on the same dollar in net terms. But the cash flow timing matters. Layer 5 is benefits replacements. You are now paying for your own health and dental coverage, your own disability insurance, your own life insurance, and ideally an extended health services plan that lets you deduct medical expenses through the corporation. Budget $3,000 to $7,000 a year for this. Layer 6 is your professional infrastructure. Your accountant and you will need one. And this will cost between $2,000 and $5,000 a year. Your incorporation, the registered office, and annual returns are another $500 to $1,000. Your software, your hardware, your professional dues such as PMP, CBAB, renewals, errors and omissions in insurance, a Microsoft 365 license, a CRM, conference travel, budget another $3,000 to $5,000 annually at a minimum. Layer 7 is your pension replacement. The employer match you used to get is gone. If you want to maintain the same retirement savings trajectory, you have to fund it yourself now, either through RSP contributions, TFSA contributions, or investments inside the corporation. Conservatively, 10% of your gross revenue should be earmarked for retirement savings. Most independents skip this step, and then in their 50s, they look up and realize they have undersaved by a decade. Do not be one of them. Let me give you a worked example. So this is not abstract. Take a senior business analyst in Ontario billing $900 a day. Assume 200 billable days. That's $180,000 in gross revenue. HST passes through, so we will ignore it for net income purposes. Now we subtract direct business costs. Accountant, $3,000. Incorporation maintenance, $1,000. Errors and omissions insurance, $1,500. Software infrastructure, $3,000. Professional development and dues, $2,000. Health benefits through a PHSP, another $4,000. That's about $14,500 in business expenses. Net active business income inside the corporation, $165,000 and change. Corporate tax at the small business rate of around 12.5%, roughly $21,000. So after corporate tax income inside the corporation, about $144,000. Now you pay yourself. Let's say you take $120,000 as salary, leaving roughly around $24,000 inside the corporation for retained earnings and investments. Your personal tax on $120,000 in Ontario, assuming there's no other income, is around $32,000 to $35,000 in combined federal and provincial tax, including CPP. Including CPP contributions, which you now pay both sides of. So your take-home pay, personally, approximately around $86,000 to $88,000. Now let's compare that to staying employed at, let's say, $140,000 base salary at the bank. Your personal tax there is around $44,000, take home $100,000, plus you had a pension match worth, let's say, $80,000, plus benefits worth $4,000, plus 3 weeks of paid vacation that you actually took. Effective total compensation experience roughly around $112,000 on a comparable basis. So in this example, billing $900 a day at 200 days, you have netted around $88,000 personally with $24,000 sitting inside the corporation. Let's call it compensation of around $112,000, the same as the bank job. So you broke even. This is the math that people miss. $900 a day, 200 days looks like $180,000 gross. And people compare that to $140,000 salary and they think they've given themselves a $40,000 raise. They have actually given themselves a lateral move with more risk. So what's the rate that you actually need? Here is the rule of thumb that I use and that most accountants in this space will validate. To achieve genuine lifestyle improvements after going independent, not breaking even, but actual income gain, you need to bill at roughly 1.5 to 1.75 times your fully loaded employee compensation, divided by your realistic billable days. So let me translate this for you. If your total employee compensation, including base, bonus, pension, and benefit is $180,000, multiply that by 1.5. That comes to $270,000. Now divide that by 200 billable days. That's a target day rate of $1,350. If you're billing $1,100 a day at 200 days, you are roughly at par with that 180 total comp number. If you're billing $1,400 a day, you have meaningfully improved your economic position. If you're billing under $1,000 a day with that level of seniority, you are definitely losing money relative to staying employed. Even though the gross number looks a bit higher, let me tell you why within my own market, which is, being a senior business analyst, project management consultant, the rates are in the range of around $900 to $1,400 a day for senior independents through things like your prime vendors, and $1,200 to $1,800 for direct or executive level engagements. That variance is real, and things like your role, your clearance, your specialization, your relationships, your negotiating posture, every one of these moves the rates. We'll talk about how to actually negotiate all of this in episode 4. Remember, the rate is not the metric. The net per billable day after all of the above is what really matters. When someone tells you they're billing $1,000 a day and you should be billing $1,000 a day too, the right question is not what's your rate. The right question is what's your net billable day after corporate taxes, after personal taxes, after benefits replacements, after retirement contributions, and of course, all the business overhead. That is the only number that tells you whether the number is working. So make sure you run your math before you sign anything. Use real numbers. Use conservative billable day assumptions. And then add a buffer, because the first 18 months of the independent practice almost always feature a contract gap and the slow ramp that you did not forecast for. I'm gonna put a free spreadsheet in the show notes called the Independent Consultant Math Sheet. Walks you through this calculation with editable inputs for your day rates, your billable days, your province, and the benefits. So all you need to do is plug in your own numbers before you sign anything and make sure that number works for you. If you found this helpful, make sure to follow the show, share the episode with one senior colleague who's thinking about going independent, and connect with me on LinkedIn for more ongoing tactical content. In the next episode, we get into the legal structure, things like sole proprietorship, corporation, or the personal services business trap that catches more independent IT and finance consultants than any other tax issue in Canada. You don't want to miss that one. I remain Kes Edafiogo, and this has been Career Leverage.